same shelf. 3 identical tablets, 3 different costs hiding inside. That is inventory, and this is Chapter 6 summarized. FIFO, LIFO, average cost. The whole chapter in one sitting, cut for exam night. Every method is explained in full in the 3 lectures linked below. The setup, exactly as Chapter 5 promised. Pixelpad bought the same tablet 3 times while the price climbed. January, $200. June, $220. November, $240. A customer walks out with one, which cost just left the building. You pick the story, and your pick rewrites ending inventory, profit, and the tax check. It all lands on one cheat card at the end, free on the site. Let's go split the bucket. One dataset, one formula, all night, both straight out of Chapter 5's cost bucket. Copy this schedule down. January, 60 units at $200, 12,000. June, 90 at $220, 19,800. November, 130 at $240, 31,200. Now total the pool. Add the units, 280 available. Add the dollars, 63,000, the cost of goods available for sale. That number is a fact. No method ever touches it. Then the December count finds 160 units left, so 120 sold. Count what remains, derive what sold. The engine behind that, beginning inventory plus purchases equals goods available. Goods available minus ending inventory equals cost of goods sold. And the bucket has exactly 2 exits. Chapter 5's pair, ending inventory to the balance sheet, a current asset. Cost of goods sold to the income statement, an expense. Inventory is an asset only until it sells. 4 legal stories exist. Specific identification, which just tags each unit's real cost and reads the tags. FIFO, LIFO, and average. And your story need not match how boxes physically move. The milk aisle rotates oldest out, while the books assume the opposite. All legal. Cost flow is a bookkeeping choice. One decision is still open though, when the costing runs. Before any method runs, meet that fork. 2 systems, and they differ by a single word. When. Periodic settles up once, at year-end. Perpetual recosts the shelf the instant every sale rings. Same year, one twist, watch the running ledger. January 60 at 200, June 90 at 220. Then, August 20th, 120 tablets sell at once, months before the priciest batch exists, and the balance drops to 30. Only then does November land. 130 at 240. Same 63,000 bucket. Same 160 units at year-end. Picture a stack of pancakes. Every buy drops a fresh one on top, and the sale picks from the plate as it exists right then. So the order flips. Periodic counts the shelf first, cost of goods sold falls out. Perpetual costs the sale first, the shelf falls out. Same identity, opposite ends. And one habit before the boards, keep that purchase table in front of you every single time we calculate cost of goods sold or ending inventory. January, June, November. Every number we are about to compute comes straight off those 3 rows. Now, make a call before the 3 boards. With November out of reach in August, which methods will even notice the difference? Lock it in, the scoreboard settle it, method by method. First method, worked in full. FIFO, first in, first out. The rule in plain English, the oldest cost on the shelf is always the first cost out the door. So the newest tags are what remain. One board, both systems. Start on the periodic side, it waits for year-end, then splits the bucket in 2 steps. Step 1, price the 160 counted units from the bottom of the schedule up. All of November, 130 at 240. 31,200 plus 30 June units at 220, 6,600. Ending inventory, 37,800. Step 2 is the pure engine move, 63,000 in the bucket. Minus that shelf leaves 25,200 of cost of goods sold. Now the perpetual side runs at the August sale itself. Step 1, cost the sale with the oldest layers on hand right then. 60 January units at 200, 12,000. Then 60 June units at 220. 13,200. Cost of goods sold, 25,200. The identical answer. Step 2. Ending inventory is simply what is left on the shelf. 37,800 again. So the verdict strip. FIFO ties. The bottom of the pile never moves, so when you cost the sale cannot matter. Specific identification ties for the same reason. The tag rides the exact unit. Compute FIFO once. Quoted under either system. Free marks. Now the troublemaker, LIFO, last in, first out. The rule flips. The newest cost in is the first cost out, so the oldest tags are what remain. And this time, the 2 systems will disagree. Periodic first, same 2 steps. Step 1, price the 160 counted units from the top of the schedule down. 60 January units at 200, 12,000. All 90 June units at 220, 19,800. And just 10 November units at 240, 2,400. Ending inventory, 34,200. Step 2, the engine again, 63,000 minus that shelf is 28,800 of cost of goods sold. A full 3,600 more than FIFO because periodic waited and its sale reached all the way into November. Perpetual cannot do that. Step 1 runs at the August sale, and November does not exist yet, so the sale takes the newest layers on hand. 90 June units at 220, 19,800. Then it dips 30 units into January, 6,000. Cost of goods sold, 25,800. Step 2, the shelf that is left. The 30 January units, 6,000, plus all of November, 31,200 when it finally lands. Ending inventory, 37,200. $3,000 of gap between the two answers. Pure timing. In my teaching days, this exact trap caught half the class every semester. You cannot sell November and August. So the verdict strip. LIFO moves. Same method, same year, 2 different answers. And the exam happily asks for both. Last method, average cost. Stop picking layers and blend one price for every unit in the pool. And even the blender splits on timing. Periodic blends once over the whole year. Step 1, the blended price. $63,000 over 280 units. $225 a unit, exactly. Step 2, that one price costs both sides of the split. 160 units still on the shelf. 36,000 of ending inventory. 120 sold, 27,000 of cost of goods sold. Together, they rebuild the bucket. Perpetual blends at the sale instead. Step 1, August. The cup holds $31,800 across 150 units. $212 a unit, exactly. So the sale costs 120 times that. 25,440. Step 2, November lands and the blender restrikes. 6,360. Still in the cup, plus 31,200 of new fruit, over 160 units, $234.75. Ending inventory, 37,560. The $1,560 gap is pure timing. The August blend never met November's prices. So the verdict strip, average moves, blend later in rising prices, and the answer moves with the calendar. Put the 3 periodic answers on one ladder, prices rising. Ending inventory, FIFO highest at 37,800, average in the middle at 36,000. LIFO lowest at 34,200. Cost of goods sold flips the seesaw, 25,200, 27,000, 28,800. The 2 lines always move opposite ways. And everything downstream just inherits it. Gross profit, income before taxes, the taxes themselves, FIFO fattest, LIFO leanest, average forever in between. Cost of goods sold is the only door the method choice ever walks through. That grid is the instinct a working analyst runs on autopilot. So why pick LIFO and look poorer? Because the leanest paper profit writes the smallest tax check. Real cash still in the drawer. The guardrail is consistency. Pick a method and stick with it, or your own trend line turns to garbage. Learn the FIFO column and mirror it. One column buys the grid. One warning before the estimation tools. This whole machine leans on the count, and a miscount rides the formula all the way down. Ending inventory sits inside cost of goods sold. Understate ending inventory and cost of goods sold comes out overstated. So gross profit, net income, and the equity they feed, the equation you have balanced since Chapter 1, all land understated. Overstate the count and everything mirrors up. Then the boomerang twist. This year's ending inventory is next year's beginning inventory, so the error flips its sign and cancels across the 2 years combined. Say account ran $5,000 high, profit shows $5,000 fat that year, $5,000 lean the next, and dead on over the pair, while each single year still lies. Auditors are built on this boomerang. Last leg, the day you cannot count. Fire, flood, theft, or an interim month when a full count costs too much. 2 estimation tools. Tool 1, the gross profit method. Your margin is a recipe ratio. If 40 cents of every sales dollar is profit, 60 cents is cost. Sales plus last year's margin back you into everything. Watch it work on the income statement. Net sales, $200,000. Margin, 40%. So gross profit is $80,000, and the goods that sold must have cost $120,000. Then the shelf card, the same engine as all night. $30,000 of beginning inventory plus $110,000 of purchases is $140,000 available. Strip out the $120,000 that sold and $20,000 should still be sitting there. Nobody walked an aisle. And the placement you now know cold. Chapter 5's two exits again. Cost of goods sold to the income statement. The $20,000 estimate to the balance sheet. Current assets. Tool 2. The retail method, built for stores whose whole world is price tags. The rack speaks retail. The balance sheet wants cost. The bridge is a single ratio. Keep both columns. Goods available, $90,000 at cost, $150,000 at retail. The till rang $120,000 of sales. Step 1. The retail still on the shelf. $150,000 minus $120,000 leaves $30,000 of tags. Step 2. The cost to retail ratio. $90,000 over $150,000 is 60%. 60 cost cents in every retail dollar. Step 3. Shrink the tags. $30,000 times 60%. $18,000 of cost straight to the balance sheet. And the exam trap that outranks both tools. Neither estimation method applies lower of cost or market. They are shortcuts to a cost figure, not a market test. One last override outranks whichever method you picked. Lower of cost or market, conservatism at work. Your FIFO shelf says $37,800, but market value has slid to $31,000. Report the lower, $31,000, and the $6,800 write-down hits the income statement as an expense. This period. You write inventory down, never back up. Bad news early, good news waits for the sale. And keep the boundary. This rule is for inventory you actually hold. The estimation shortcuts never apply it. Exam simulation, pause and earn it. My students requested this exact rerun before every midterm. A fresh schedule, 40 units at $50, $2,000, 60 more at $65, $3,900, 50 more at $70, $3,500, 150 units, $9,400 in the bucket. The count finds 50 units left, so 100 sold. Find ending inventory and cost of goods sold under both FIFO and LIFO. Same two steps. Pause now. Check it. FIFO keeps the newest. Ending inventory is 50 at 70, 3,500. And cost of goods sold is 9,400 minus that, 5,900. LIFO keeps the oldest. 40 at 50 plus 10 at 65, 2,650. Subtract it for 6,750 of cost. Both splits snap back to 9,400. Always. Nail both and you just did the chapter's hardest computation. 10 more are waiting in the free practice set on the site. Link below. Screenshot time. The entire chapter on one card. Exam radar first. This chapter shows up 3 ways. Split the bucket under periodic. Recost a sale live under perpetual. Or estimate a shelf you cannot count. The card answers all 3. Left, the bucket's 3 splits. FIFO, average, LIFO, each has the rule you reuse on any question, and the perpetual scoreboard under them. FIFO and specific identification tie. LIFO and the moving average move. Middle, the rising price ladder, the miscount boomerang, and lower of cost or market, down, never up. Right, both estimation tools, step by step, and where each number lands. The traps ride the footer. Cost flow never has to match physical flow. Cost of goods sold is derived. You count the shelf. And no estimation method touches lower of cost or market. Scan the code for the printable card, camera roll, exam morning. And that's Chapter 6, whole, in one sitting. You can split one bucket 3 legal ways. Recost it live the moment a register rings. Trace a miscount through 2 years and put a defensible number on a shelf that burned down overnight. A complete exam-ready toolkit. If this recap earned its minutes, the full lectures go deeper on every beat. Part 1 is on screen right now, the full course playlist beside it. The practice sets, notes, and full-size card are free on the site. Link in the description. From my teaching years, the students who cram with a map, not just courage, walk out of that exam grinning. That is you now, the future CPAs, CFAs, and CEOs in this room. Next up, Chapter 7. Accounting Information Systems, the machine that records every number before it ever reaches a statement. Hit like, subscribe, and I'll see you in the next class.